Hello and welcome back to another video. My name is Exo, and in today's video we have yet another stock review. This time is on Polymetal International. So we'll take a look at the company, what it does, its background, then we'll take a look at the fundamentals, then we shall take a look at its income statements, balance sheet, cash flow, all that good stuff to determine if this company would be right for your portfolio. Now without further ado, let's get right into the video.
I fight to live, I fight to strive. One day I'll have what I want in life.
Make sure to go over to the Exo channel, hit that subscribe button and hit that notification bell to stay up to date with all the future videos. Before we continue, I must say that nothing in this video is financial advice and you shouldn't take it as such. I am not a financial advisor, I'm just some guy on the internet saying his opinion about topics. Now that out of the way, back to the video. Now Polymetal is a gold and silver mining company. It's actually ranked 3rd in the world in terms of silver mining, and it's in the top 10 in terms of gold mining. This company is quite unique as a lot of its process is done by mechanical and automated machinery. This is unique as it will reduce its operating costs as it gets rid of some of the workforce in place of automation. It makes it safer as cave-ins, collapses, stuff like that won't affect the machinery. Also, it allows the mine to run 24/7, meaning it has better ore production and extraction, which then helps its revenue and its growth through that process. The current depth of this mine is about 241 meters, and it has plans to expand that down to 690 meters. So as you can see, there's still a long way for this company to dig down. And obviously this is just one of its mines I'm talking about now. This company actually holds 9 mines and they are both producing gold and silver. That is one of the things this company strives for, is to have producing mines. You can have any kind of mine, but if it's not producing, we'll talk about its key goals later, but if it's not producing, it's not going to make you the money, so there's no point. All of Polymetal International mines are located in Russia and Kazakhstan. It has no plans to grow beyond this region. It is dedicated to staying in this region and finding new mines within the region. However, with Russia being such a large place, this really isn't a problem. There's plenty of mines to do and they have a growth program that allows them to find new areas to mine. Now we'll go over to their website now to take a look at some of their key goals and some information they have in general. Okay, so now we're on the Polymetal International website. So the first thing I like to do whenever I'm looking at a new company, I just go on the About section. Most companies always have that, so I just click on that and then I just have a read through of kind of what they have. So everything I've said so far I've just found off of this exact website, and then I like to cross-reference with other material to see if it stacks up. So you can see it says here 2nd largest in Russia for the gold production. 2 countries where the company operates, like I said, it was Kazakhstan and Russia, and then 9 producing gold and silver mines. There's quite a few employees that you can see down there, and then this kind of stuff is a bit, just doesn't mean too much really in terms of us, but it says up here company is a member of an impressive pipeline of future growth projects, so that's where the growth would come in that I said about. It's in the FTSE 100, FTSE Gold Miners and the MSCI Russia. These are just like indexes and funds that you can get. So being in the FTSE 100 gives it some validity to its name. Down here is some of the key highlights that the company has given us. So we can see gold equivalent production has a steady increase throughout, and then in 2020 hit its highest peak there, which is a good sign to have. We've got its adjusted EBITDA, and we can see this in 2020 was its highest, and then free cash flow again in 2020 was at its highest. So it's going in the right direction, as we can see throughout all of this. This is growing quite slowly, but at least it is growing, and we'll have a look at the key goals it states and you'll see that that fits in with its business model. So I think its key goals, if a business model maybe. Okay, so here we are on the key goals and strategy segment. So we can see its key goals are to pay a significant and sustainable dividend through the cycle. So we'll go through the dividend payments and how much it is. It's quite a lot considering most companies don't pay a dividend this high, so it's good to see. continue to grow our business without diluting its quality for its shareholders, and then exemplary ESG performance. Now ESG is basically just a conversion of its mines to gold and silver production. So obviously you don't want a mine that's just waste rock, otherwise you can't fucking do nothing with it. So that's what it's referring to there. This is another good bit to look at: strategic, objective and performance. So it shows you performance in 2020 and its targets for 2021. So we can see that in 2020 it was up 4% year on year and 4% above the original guidance. So its GE production is doing well. It wants to basically have 1.5 GE produced in 2021 as well. That's just a target, but since they've already beaten 2020, it would make sense that they would beat it for 2021 as well. And then here we can see that its adjusted EBITDA is up 57% compared with 2019. Has 608 million dividend proposed, $1.29 per share, and then 10% increase in reserves. So that's robust performance. It's got delivery growth and secure in the future. So the growth, they're just building new sites, infrastructures, equipment and whatnot, and then secure in the future. These are like reserves they have apparently, so they seem to have quite a lot of gold and silver in reserves. And then this part, I guess, is just keeping up with government guidelines and whatnot. Not too much really there to shout home about. So we'll head over to Simply Wall Street now and take a look at the company in more detail, looking at some of its numbers. Okay, so now we're on Simply Wall Street. Now this website has actually changed, so bear with me while I try and wrap my head around some of the things. Some of it's still the same though. So when you first go on, you'll see company overview, and up here you'll see the name of the company you're with, and then the ticker is here. So ticker for this company is Poly, and it shows a market cap down there of 6.2 billion. Now this does not look very good either, as the 1 year is minus 23% and minus 1.8 in the 7-day period. These are little ticks and some things to note about this company, some of the problems it might have, and this is just a snowflake showing how round it is or what it's focused on. Down here it shows some of the competitors, and this shows the history and performance of this. So we can just put it to max, and we can see from 2011 to current, or 6th of September, no, there we go, 20th of September there. So you can see it's sort of gone up there, and then it's been teetering down a bit at the minute. Not sure why that is as of yet. I might try and see why that is. Here it shows you recent news, updates and whatnot about the company. It's very nice to have. Here it shows you shareholder returns, return versus industry, and then down here. Alright, so this is where kind of the fundamental starts a bit. I don't focus too much on pricing, if the company's going up, down or whatnot. I just focus on the fundamentals of the company. The pricing will just follow if you've got a good business. So you've got 7.5 P ratio there, and you can read what that says there. If you highlight over things now, it'll tell you what it is, which is quite handy to have, especially for new investors. You've got the price to sales ratio over here, and then it just shows you the revenue and earnings down there. Down here it breaks down the earnings and revenue. So you've got 3 billion revenue, you've got the cost of revenue of 1.03 billion, the gross profit of 2 billion, expenses of 845 million, and earnings of 1.1 billion. You can see the earning per share is 2.39, the gross margin is 65.71%, net profit margin of 37.58%, and a debt to equity ratio of 104.3. Now this is quite high, which I'm not the greatest fan of. However, with the balance sheet we'll look at and its debt management, it's sort of heading in the right direction, but we'd like to see this come down. Got quite a nice net profit after it's paid for its expenses though, which you can't complain about. The dividend is where this company really shines. 7.5% current dividend yield, payout of 56%, so that's sort of the mid-range of payouts. If this got too high, I probably would consider going elsewhere. Depends if you're an income investor, dividend investor, whatever you might be. Valuation for this company is one thing that's going for it. We have a current price of 13.02. This is all in pounds UK, and then the fair value is 53.45 pounds. So quite at a discount at the minute. So it's a good chance to pick it up if you're bullish about the company or believe in the company. If you don't, then obviously there's no point. This just repeats what I've just said there. The price to earnings, we can see this is still the same. Price to earnings versus industry is just in line with it, so nothing to complain about there. And price to market, see the company and the industry is better than the market. But I said you can't really compare things like this against market. They're so different, industries and sectors are different, so I don't even see the point of trying to do that unless you're determining an overall crash or an overall bull market. Price to earnings growth ratio is good, so that's nice to see, nicely in the green. Price to book is overvalued based on its price to book ratio compared to the Great British metals and mining industry average of 2.2. That's not the greatest to see, but hey ho, I'm just giving you the facts here. It's up to you to determine your opinion about this company. Future growth of this company, we can click here, free cash flow and cash from operations, to see it all. This was a nice thing I found about this company, is everything's just growing in line with each other. Like all of it's just growing and growing in line, so nothing's out of place. It's hard to predict in the future years what's going to happen. It has it here, some analyst expectations, but they just look like they're about to level out. But we shall see how it plays out. You can see down here analyst future growth. So the company is predicted to be up here 11.8, and the industry is predicted to be declining at 16, with the market at 13.3. That's the annual earnings growth. Annual revenue growth, the company is predicted to be better than the industry and apparently beating the market. It's really hard to predict certain things like this though, so it's kind of just better to focus on its balance sheet of its revenues and whatnot. So you can see here, forecast earnings growth 11.8% per year of the saving rate. Earning versus market, like I said, don't really care when I'm trying to do things against market. High growth earnings, they're forecast to grow but not significantly, but the company's statement was not to grow significantly, it was just to grow and then deliver as much dividend payment as it could really. Revenue versus market, revenue 6.1% per year is forecast to grow faster than the UK market, and is forecast to close slower than 20% per year. But like I said, it's not a high growth thing, so if you're looking for that, this is not the company. Earnings per share growth forecasts, that's already ticked on. We can see that's just the way that it's gone in the minute, and then that's just the way they're predicting to go in the future. So this looks like a bit of a weird graph, but you know, that's what they're predicting. Predictions for me are not really the thing I care about too much. I'll look at their balance sheet and that's the main one I care about. Future return on equity, it's supposed to be high in 3 years, so that would be nice. I feel like this company is a bit slept on, to be honest, but I don't know. It's so hard to find things about companies nowadays. Past performance, again, past performance is a nice metric to see how it survived during like hard times or whatnot, but the past obviously isn't indicative of the future. You can see all this is just growing in line with each other, which is still doing now, so that's just, I guess, firm belief that the company's just a steady grower and doesn't fluctuate too much, which I'm completely fine with, to be honest. There you go, has high quality earnings and it's profitable. That's all I can ask. Now we can see past performance growth analysis, company, industry, market, and then company, industry, market. The last 1 year earnings growth for the industry was stupid apparently. The annual earnings growth past 5 years this company has beat. So whether this trend will continue, and the market will just stomp this company. Remains to be seen, but who knows. Both the return on asset and return on capital employed were good. We've had company of 24.6% compared to the industry of 13%, and last year the capital employed was 37.5 as opposed to 15.6. This just means this company is very effective in how it uses its money, and any money that investors give to them, they are quite good at actually delivering some sort of result with that money. They don't just line their pockets with it, basically. You can see the financial health of the company here. So the short terms do beat the short term liabilities, and the long term assets beat the long term liabilities. Ideally, you want to see the short term assets outweighing the long term liabilities, but if it's managed okay, this isn't too much of a problem. Debt to equity, we can see here, return on cash and equivalents. This is not like a great cash producing company. You'll never outweigh the debt with the cash like Microsoft does, but the equity is now coming in line with the debt, and it's probably will surpass it soon. It had a surpass there at that point, and then obviously pandemic hit, they raised some of their pricings to match that, but not too much of a problem. Reducing debt has reduced it from 197.8% to 104.3%. It's going in the right direction, like I said earlier. And then the debt is well covered by its operating cash flow of 59.6%. Nice to see. And then its EBIT is well covered, like I showed you earlier. You can look at the balance sheet later. I don't really like the way this one looks. And then we can see the dividend is 7.5%, 7.49. Industry average is 8.4, so obviously mining sector has quite a high dividend payment. I don't know if they're required by law to do that, or they just have, I don't know, really hard time finding capital for it. Forecast in 3 years to be 8.9, which would be a hell of an income generating company if that was you're into. I know the dividend pool likes his income, things like that. Noble dividend, high dividend. Yep, yes it fucking is. Yep, earnings per share on the stability and growth of the payments. So you can see it's been going quite a few years now. Obviously not 10 years, but paid a dividend for 9 years, so. But as long as earning per share increases, its dividend per share is increasing. So it's doing what it says it's going to do with its key goal of delivering dividends sustainably and a high dividend. Current payout to shareholders of 56%, and the future payout is predicted to be 84%, depending on, I guess, its growth. If it gets loads of gold and silver out the ground, then I guess this payout wouldn't be very bad, but again, the future remains to be seen. You can look at management. One thing I liked about this company is more of the shares bought. So people have been buying shares, insiders have been buying shares in this company, almost sold shares. It's all been buys. You can see down here, buy. So that's a good symbol to have. I mean, with the valuation, it's really, you might as just, you're not risking too much capital, depends on how much you invest obviously, but I do own a little part of this company, as it is a part of my dividend portfolio. If you're not into the dividend thing, then obviously wouldn't go for this company, just absolutely not. I'd go for Microsoft or Facebook or something like that. I had a video on undervalued stocks, go check them out. And now we'll check out the income statements, balance sheets, cash flow, and wrap this up. Okay, so now we're on Yahoo Finance with the income statement of Polymetal International. So we can see from 2017 to trading to 12 months. So currency in USD, all numbers in thousands. So with total revenue, we can see that from 2017, there's been pretty much a steady increase throughout until now. So that's a good thing to see. I think this company is quite good at delivering what it promises. High dividend, sustainable, and a little bit of growth. It's not trying to go mad. It's just sort of slow and steady wins the race kind of thing it's doing. Cost of revenue, again, that's grown steadily throughout the years. Sort of fluctuating up and down a bit. and sit at. There we go. Gross profit, again, we've gone consistently up with this one, which is a nice one to see, go consistently up. Operating expenses again, sort of stayed around the 200,000 range, with trailing 12 months being its highest, but it's not jumped too much, so not much of an issue. Operating income again, we're at its highest now, and then it's just been consistently going up. The net income, there we go. Net income, we can see that that's gone up as well to its highest point now. Again, steady increments and jumps. Well, these ones were quite a big one, but from here to here, it's not too bad. You can look down here at all of it, total expenses. You can see this, it's sort of just stayed in all this range, so it's quite managed. They're not going too crazy with total expenses. There's EBIT. Again, we can see it's as highest as it's ever been right now. EBITDA, we've just got the one number there. So now we'll take a look at the balance sheet and have a look what that's saying. Okay, so now we're on the balance sheet of Polymetal International. Again, from 2017 to 2020. We can see their total assets have gone up, which is nice to see. And its total capitalization has also increased. So it is doing good with the money it's get given. It's expanding its sort of network and its assets column. As long as the assets outweigh their liabilities, they're calm. So its total debt from 2017 to 2020, it's gone up. It's not gone up like a ridiculous amount. From here to here, there's not really been much of an increase, which is it's a shame you can't see the 2021 numbers yet, because obviously it'd be nice to see how that pandemic affected this total debt if they had to take on a lot of that. But yeah, that remains to be seen, that one. So you can break down the total assets here, current liabilities, current assets. Where's this one? Current liabilities. Current assets 1.375. Current liabilities. There you go. Those current assets do outweigh the current liabilities here, which is nice to see. And then the last one to take a look at is the cash flow, and then a little conclusion about the company. Okay, so now we're on the cash flow section. You've got operating cash flow from 2017, and then the trailing 12 months. You can see the operating cash flow has gone quite an increase from 2017. And then free cash flow is another important metric to look at, and we can see that that's increased quite a lot from 2017. This will keep needing to increase to pay off the dividend and still be safe while doing so. So as long as they can do that, this company will be fine. Okay, so now for the conclusion. Okay, so in conclusion, this company is neither good nor is it bad. It has some good things going for it, has some things going against it. I think it all comes down to what investor you are. If you're a dividend income investor, then this company might be a good thing for you to get. If you're a growth investor, definitely not. This company just has a lot of sort of unknowns about it. A lot of it sort of depends on its future. If it can sustain that dividend, if it'll have enough free cash flow to do so. If it doesn't, then it's pretty much fucked. The dividend is kind of the only attractive appeal to this. You're not going to get the capital appreciation from this. The valuation's a nice point, but if the price doesn't move, then not really much of a thing there, is it? So I do hold a little bit of this company. I'm currently figuring out whether to move away from companies like this and focus on some other ones I have. It all remains to be seen. So, like I said at the start, I'm not a financial advisor. Do not take any of this as financial advice. You'll have to make your own mind up on this company. Like I said, I have some good things going against it, some good going for it and against it. So, you just have to make your mind up on that one. So, hope you enjoyed and got some value out of this video. Check out all the links in the description. Trading212, get free share when you use that link. All the Blockfi and Gemini links down there for your crypto needs, and whatever links I'll put down there for investors. and I'll catch you in a bit. Peace out.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.